Hello, everybody. I'm Mark Neuman, CIO and founder of Constrained Capital, creator of the ESG Orphans Index. Stay tuned for episode 3 of the story of the ESG Orphans, Truth in ESG. We'll be right back. Welcome back, everybody. Today we'll be talking about episode 3, the truth in ESG, the story of the ESG Orphans. We will review a little bit of what got us here via the YouTube presentations we did in the past few weeks. We'll talk about the fundamental story behind the ESG Orphans, and then we're going to open up the floor to a bunch of questions that I've received over the past few weeks to talk about some of the aspects of the ESG Orphans. As a reminder, we filmed 2 other YouTube episodes in the past few weeks. One of the episodes had the esteemed NYU professor, the Dean of Valuation, Aswath Damodaran, talking all things ESG. That was the Emptiness in ESG episode. In that episode, Professor Damodaran and I discussed the costs involved with ESG and the lower returns that come with ESG investing. His conclusion was, you can't have cake with no calories. Like religion, there's always a sacrifice to be made, and there are costs, and it is not easy, and it is sometimes painful to make those sacrifices. Basically, at the end, Professor Damodaran said the minute BlackRock has to tell everybody that ESG has higher costs and lower returns, the general ESG investing landscape will be turned on its head. In addition, he talked about the fiduciary liabilities and the risks potentially growing for BlackRock for misleading investors, and we're starting to see some of that fallout now. In the other YouTube video that we created, we had another expert on. That was Dr. Alhajji, renowned energy expert. We talked fossil fuel, we talked nuclear energy, and we discussed the misconception of ESG investing with regard to energy. A couple of the pointed terms that Dr. Alhajji and I discussed were, number 1, the demand for fossil fuel amongst developed nations and developing nations will always be around. It's not going anywhere. And then the other point he made about nuclear energy was, if you believe in peak oil, we have to have nuclear energy going forward. In addition, if you believe that the emissions from fossil fuels are going to be too much to bear, then we're definitely going to need nuclear energy going forward. Dr. Alhajji's conclusion overall was, there's plenty of money to be made in fossil fuel and nuclear energy companies going forward. Now, I remind everybody, those were 2 experts in their own field, giving us opinions based on their research. Please consider that when making any sort of investment decisions. Now, in case you missed previous stories where we talked about the history of ESG orphans, I'm going to run into that real quickly and give a brief synopsis review. So, one of the hedge fund legends, the quantitative analyst Hall of Famer named Cliff Asness, who ran and runs actually the hedge fund AQR, he wrote a piece called Virtue is Its Own Reward. One man's floor is another man's ceiling. In this white paper in early 2017, he talked about virtuous investing, sin stocks, constraints on capital, and how that leads to misallocation of funds and malinvestment overall. He mentioned tobacco stocks. That's really what started to pique my interest. He said these stocks under exclusions are higher expected return securities. That's when I started to dig in. I did thousands of hours of research. I read prospectuses. I read about the rating agencies. I screened all the stocks. And along the way, I found Professor Damodaran's blog posts. The professor wrote a blog post, Sounding Good versus Doing Good, a skeptical look at ESG. In this quite in-depth piece of research, he talked about all the things I had discovered and thought about and uncovered and was thinking about much deeper. And I actually reached out to the professor and we became email pen pals and we started to discuss these things. And that's how I became friendly with him. That's how I got him to come to my YouTube presentation a few weeks ago. In any case, that's what caused me to launch this product, the ESG Orphans. So let's move on and let's talk about some of the questions that were asked by some investors, friends, people over time through Twitter. I'm going to read one question right here. Let me just check my notes. This came from Scott from California. How has performance of the ESG Orphans been? Can you give us some examples to highlight it? The reasons why, perhaps. So I want to just make it clear to the audience here. there is an ETF called ESG Orphans ETF. That's ORFN. That is the tracking stock to the index, the ESG Orphans Index. That's the index I created. And for all reference points in this discussion, we're talking about the index, the ESG Orphans Index. And when I refer to other indices like the S&P 500, the SPX, the NASDAQ 100, NDX, the Russell 2000, RTY Index, and the MSCI ESG Index, which is an index used as a benchmark for a lot of ESG funds, I am specifically referring to the indices. So, you can see in the chart that I created, the table, the performance of the ESG Orphans Index on many different durations, 1 month, 3 month, 6 month, year to date, has been a tremendous outperformer against all those other indices. In some cases, on a year to date basis, the ESG Orphans Index has outperformed some of these indices from 35 to almost 50% year to date. So things seem to be working. Let's discuss some of the aspects as to why they might be working. Well, I first want to point to the constraints on capital thesis. The underlying story is malinvestment, misallocation of capital. And the biggest example, and I actually touched on this example on Fox Business News last week. If you look at Amazon, this is, obviously everyone knows what Amazon is. This is what I call an ESG darling, but it's for a non-energy company, it has arguably the largest global carbon footprint. It's something of a stock, an investment, but it is not ESG. Yet, it's the number 3 holding at several prominent ESG funds. In fact, my research shows that Amazon exists in 75 to 80% of all ESG funds. So, 95% of Wall Street analysts have Amazon as a buy. It is something, as I said, but it is not an ESG investment, and it is down 40% year to date. This is what happens when there's misallocation of capital and malinvestment towards an investment idea that is not for the right reasons. On the other side of that, let's talk about capital constraints on fossil fuel. ExxonMobil is the biggest position in the ESG Orphans Index at nearly an 8.5% weight. Less than 50% of Wall Street has this as a buy rating. It is the villain. It is arguably the poster child for the ESG movement, And as a result, it's being discarded, excluded, due to regulations, due to disincentives. And now this stock, ExxonMobil, is up 80% year to date. So you have the ESG exclusion, ExxonMobil, the orphan, and the ESG darling, Amazon, and the ExxonMobil darling is outperforming by over 100% year to date. This is what happens under capital constraints. Now, it's very nuanced, ESG investing, because look at the weapons sector, for example. When we decide as a country to send aid to the Ukraine, Ukraine turns around and buys surface-to-air missiles from Raytheon. Raytheon is one of the ESG orphans, part of the index, and yet it is being used as a source of weapons. So this is the nuanced behavior that we're seeing in ESG that is causing this disparity. Now, overall, interest rates are higher, quantitative easing is no longer, and we have inflation. So we have energy and food insecurity on a macro basis. These are all contributing factors that explain why the ESG orphans continue to outperform. So let's move on to another question. This one comes from John from Texas. What makes the orphans unique versus others? Explain the concept of anti-ESG. So the ESG Orphans Index is a diverse basket of anti-ESG investment ideas. It has isolated the ESG factor across multiple sectors. Because it is evenly distributed on a market cap weight basis, it is only 25% fossil fuel, 25% nuclear energy, 21% weapons, 12.5% each alcohol and tobacco, and a small 4% to gambling. But it is diverse across the ESG aspect. It's not a sector-based ETF and index, but a factor-based. So there are some competing indices, ETFs out there. For example, there's a betting and alcohol and drugs ETF and index. There's a gambling index. There's an oil index that claim the anti-ESG stance. Those are sector-specific anti-ESG type funds. You can see in the next slide that I'm going to introduce, it shows the comparison. Now, one thing I will add, the nature of the ESG Orphans Index at a $3 trillion valuation as market cap. It has 50 names. That's $60 billion on average for each company. That is a mid-cap type basket. That's some of the type aspect that it is. In addition, because of its fundamentals from price to cash flow, price to earnings, enterprise value to EBITDA, it has a value orientation to it as well. Now, what I've done in this next table is include the alcohol and drugs index, the gambling index. I included the mid-cap index and a value index to see how the ESG orphans are performing against all of those. The competing sector ones and the valuation and size indices, just to see. Now you can see the ESG orphans again outperforming all of this on multiple time frames. This shows A, the diversity of the index itself, and B, how it really could be attributed to the isolation of the ESG factor. That is the unique aspect of the ESG Orphans Index. All right, next up, Eric from Florida, he asked me, what is the outlook for ESG and how will this play out going forward? Well, as we touched on a little bit earlier, the change in the interest rate landscape. At the beginning of this year, the 2-year yield was under 1%. I think it was close to 75 basis points. It's now closer to 4.5%. And the 10-year yield was around 1.5% to start the year, and now it's closer to 4%. That is a massive move in the interest rate world. And what that does is it makes money more expensive. So what happens is people aren't as free-flowing with hiring and spending. So what happens is everyone overhires and has overhired, and that's been part of the ESG landscape. When I heard a tech company the other week say, we need to hire less and cut costs more, to me that sounds like they've hired a few too many chief sustainability officers. In addition, this past spring, I was in Florida at a conference, and a $1 trillion money manager said that they had 60 ESG analysts. My mind blew up when I heard that. If we assume $300,000 or $400,000 per analyst, that's $20 to $25 million in expenses around ESG analysts. When I mentioned this to Professor Damodaran a few weeks ago, he said the minute the flows stop in ESG, which they're starting to, and the minute losses start to pile up, those analysts, those recent hires are going to be the ones to go because there's too much excess in ESG. That's part and parcel with what we have seen. Now, in addition, as these losses pile up, I would say the chances of fiduciary risk to these money managers is increasing. We've already seen this from pension funds being told or showing disgust, if you will, and now having to remove ESG mandates on investing. In addition, we've seen attorneys general from the states, various, I think it's at least 16, maybe more now, coming after BlackRock to say, what's the story? What have you been doing? You may have failed fiduciary roles and certainly have failed objectives. So I think going forward, that is something to keep on the lookout for. In addition, as the winter approaches, I do not think the energy crisis has gone away just yet. We still have supply challenges. Demand is always going to be there. So I would say I expect to see continued migration towards the ESG orphans and away from the ESG darlings because it seems like the ESG landscape has shifted. Okay, one more question from the audience here. Richard from New York. He asked, who are the ESG orphans most suited for? What type of person, what type of investor does it make the most sense for? Well, this is the old suitability question. So as I mentioned before, those ESG analysts, the 60 at that investment manager, the ESG orphans is probably perfect for them because their career risk is tied to ESG. If you're an ESG analyst, if you're an index creator at an MSCI, let's say, and you are tied to the success of ESG, well, your risk is that ESG is not that successful. Maybe it implodes. So for that kind of person, this is probably this could be a great hedging tool. Now, that's just the lifestyle or the job related risks in ESG. As an investor, I think this is suitable, could be suitable for the contrarian, someone who wants to swim against the tide, someone who wants to put a little value orient in their portfolio, looking a little defensive, wants to get some more dividend exposure. Those are some of the characteristics of this basket. In the end, this provides great portfolio balance. You want to take a little bit more risk in some higher growth, riskier areas? Sure. But this ESG Orphans Index, this component, this ETF ORFN could provide some good balance. Now again, this is all part of the investing landscape, and past performance has nothing to do with future results. Please consult your financial advisor. Now, the final slide that I'm going to present here today includes some of these disclosures. I urge everybody to read the fact sheet, read the prospectus. Those links are provided on that final page. In addition, my email address is there. My Twitter handle is there. Feel free to reach out to me and contact me. I'm always willing to talk. In addition, I've included my websites, the ESGOrphans.com, which is the index website. That's kind of dynamic. It has a lot of live time news feeds. And you can also check out the ETF website, constrainedcapitaletfs.com. This has the prospectus, the fact sheet, the weightings, those kinds of things that are a little bit more static and consistent. That's pretty much what we're up to here at ESG Orphans, and that is a wrap. I want to thank everyone for tuning in, and I hope you enjoyed the ESG Orphans, the story, the truth in ESG story of the ESG Orphans. Please check us out on YouTube, and good luck investing.